Let's talk about debt mutual funds and the process to actually select it. Feroze Azeez, the Deputy CEO of Anand Rathi Wealth Management, joins in. Hi, Feroze. Good afternoon. So the universe itself is at 310 funds. How do you narrow it down? I believe your model portfolio has only 5. So how does 310 become 5? What's the first step?
Yes, Sumaira, I think to narrow it down and come to actionable of buying 5 schemes requires first to have an objective. So once you put the objective, then you know your filters very clearly. So let me lay down the objectives on the design first, and then I'll probably quickly run through the steps. The first objective is to have 2% more than the corresponding GSEC instrument, which is at 4.5. So your debt portfolio should ideally on a 3-year time frame make you 6.5. And when the interest rates go adversely, that is, if the interest rates go up, you shouldn't be losing more than 0.5% per annum. That is 2% in 3 years. That's the second risk objective. The third objective is to have 80% of the money in PSU and GSEC and some portion of AAA. So that 80% of your money does not carry the credit risks. In the recent past, there have been credit risk events having fructified. So these are the 3 objectives. Then coming to your pointed question of 310 schemes boiling down to 5, the first step is to eliminate those categories of schemes. There are several categories in the debt fund category. If you look at some categories which don't fit into your risk objective, and if you eliminate all of those, you're left with 4 of them, 4 categories. One is banking and PSU, dynamic bond funds, and short-term funds, and lastly, the medium-term fund. These are the 4 categories. Now, if you look at these 4 categories, eliminating the rest of the 10, 12 categories, you're left with 89. That's the first step. In the 89, you leave aside asset management companies not in the top 10 and funds which are less than 1,000 crores of AUM, because liquidity is also critical. So that brings it down to 29 from 310. And then you put subsequent filters as well.
Okay, so basically, narrowing it down, basically you work on a process of elimination and not outright selection. Is that right?
Yes, because once you write down your objective, you very clearly know what's not to be done. I think in investing, be it any stream of selection, you need to know what you first eliminate. And then you have a smaller universe. There you do a lot of homework to pick the ones which are relevant for the objective you desire to achieve.
Weightage would you give to, the risk taken as opposed to what could be the return potential? I mean, which would carry more weight when selecting a fund?
See, when you select a fund, both are 2 sides of a coin. They can't be seen in isolation. It is the efficiency. Return per unit risk is what I would call as efficiency. That takes precedence over anything else, because standalone return can't tell you the full picture. Standalone risk, a lower risk doesn't mean that it's a good fund. For the lower risk, for every unit of risk taken by the fund manager, what corresponding return did he generate is the value created rather than return created. So that would be very, very critical as a scheme selection process.
And Feroze, why the bias towards the mid to bigger schemes or the bigger AMCs? I mean, don't you think that a smaller AMC or a newer fund could do justice to, being a portion of your portfolio?
Yes, see, definitely for what purpose are you filtering is what is very critical. When you're looking at debt, the larger, the better, in our opinion. If I'm choosing a small cap scheme in the equity side, maybe I would be lesser sensitive to the size of the fund, lower the better. So when it comes to debt, I would look at larger AMCs because their liquidity and their research is going to be deeper by the virtue of the assets they manage, can afford a larger, deeper research team, especially in the current credit environment, which has transpired in the last 1-2 years. It's very critical that there has been in-house research on the debt side rather than just relying on the credit rating agencies, which have faltered in a few cases.
Okay, can you explain why portfolio maturity or portfolio duration, how do they matter in debt scheme? I mean, unless you're buying a duration fund per se, would it matter across the board, and what is the significance?
See, it matters across the board, but at different quantums, right? Some are very sensitive, some are very, very low on sensitivity to interest rate change. Why does it matter is, anytime you create a bond portfolio, when interest rates go up, your bond portfolio prices go down, right? Because the interest rates the market is getting is far more than what you've locked yourself at, and vice versa. So sensitivity is there across board, but the extent of sensitivity is different. So your overall portfolio sensitivity is what is very critical, not individual schemes. For example, if you bought a dynamic bond fund, which might have higher sensitivity, but if you combine it with a short-term fund, that will complement each other. If you bought all 5 dynamic bond funds, then your sensitivity to interest rate movements is going to be far higher than desired.
Okay. So, Feroze, what has your selection brought you down to? What are your top 5? And why do you think they're best positioned for the future?
See, after having gone threadbare out of these 29 schemes, we check very important, one thing, according to us very important, which is what they charge a fee for, is what more return than the interest accrual has the fund manager given. If the interest or the yield of the fund is 6%, and 3 years later, if you see the fund having delivered 7%, that means 1% is the extra gain because of the intellect and the research which the fund managers brought in by active management. So we check that. And we have seen the average, these 5 funds which we have chosen have generated 0.95% more than the interest of the bonds they held when the fund was bought. So that's the most important criteria. So whoever has generated active alpha over their interest accrual gets precedence in the model portfolio. And that leaves us with 5 schemes. Let me read them out quickly for you. HDFC Banking and PSU Fund, a Nippon Short Term, SBI Medium Duration, Kotak Dynamic Bond, and ICICI Pru All Seasons Fund. This as a combination, not as a standalone fund, can do justice to the risk and return.
All right. Well, Feroze, thanks very much for sharing your methodology with us. We'll try and prune our own, method of selecting debt mutual funds. But thanks.